Actually, I just typed fortunate question. He posted many screenshots, so we will use the summary, which is how to add Fibonacci levels in TradeStation and SQX to be able to test them. That's the summary I got from all the screenshots. So if not, you can type your question or you can speak up. Both are okay. So here is the sad truth, unfortunately. I read 2 studies. This is like, I don't know, I would say 7 years ago. And I have 2 books on candlesticks. And the guy who tested the candlesticks, of course now we can do it because I programmed all the candlesticks in SQX and you can test them. They all either don't work or work on the opposite side. So for example, with candlesticks, engulfing, usually if it works on the opposite. And doji, same. Or they have to be mixed with something else. And the Fibonacci studies that I've seen 2, not books, just white papers. I don't remember now. You should search on them on SSRN. They say also they don't work. However, of course, I'm in the camp of always test, like don't believe whatever they say. So we should put some general ideas here. Is anybody anywhere, YouTube, books, whatever, you need to test the idea to make sure if it works or it doesn't. Don't take their word for it, of course, even mine. But it bugs me a lot on all these trading channels. Well, they show only like a chart, especially those 2 channels where they do 100 trades. Let me do 100 trades on the chart, which of course I see the time and it's like a year and a half, the span. That doesn't mean anything unless what you're trying to do, which is code them and then test them. That's the only right way. So now comes the problem is some things are really hard to program or they are really subjective. So for example, trend line is really subjective. If we go to a chart right now, every one of us will have a different representation of on a chart. If I can find one. Okay, this one. Okay, so let me clean this. So right now, if we want to draw a trend line, let's say starting from this point, all of us will come up with different trend lines. But a regression line, it's math. All of us will come up with the same conclusion. If you started the regression line from here to here, it will always be the same. So Fibonacci falls under this subjectiveness, which is, if I draw Fibonacci now from this, should I draw it from this point or from this point? Okay, so again, subjectivity comes into place. However, you can program it, of course, and you can test it. Now, I don't have it. I used to have one indicator that draws Fibonacci, but it was a DLL file, which means basically you cannot, you can use it as an indicator to look at, but you cannot use it in the development environment to program. So, but I suggest if you want to go this path, there is this guy, Mark Plex. I have coded with him before. He's a professional programmer for TradeStation. So TradeStation is a very mature platform, and you'll find many companies that does programs. But this guy is honest and, you know, decently priced. So he can program anything for you, and you can use it as a function. So you can bring it in TradeStation and say, well, if Fibonacci is 1.5 or 1.6, then do this or do that. Of course, that solves TradeStation. You want SQX, then somebody else in SQX has to program it for you. And for that, I have CloneX, which I interviewed on the program, and you can use my code. I don't get anything, it's just for you. You can use my code to get a discount. So in summary, the more complicated, the less chance it's gonna work. And usually the general accepted idea is the wrong one. In general, this is like in general, okay? But of course, I am with you. If you want to program it and test it yourself, that's all fine. Unfortunately, the 2 books that I read and tested on candlesticks prove that it doesn't work, or it works the opposite, or it needs something else. And for Fibonacci also it doesn't work, or it needs something else to confirm. So once it needs something else to confirm, why complicate things? Because remember, it's a lot of complication. Yeah, the code will be huge. And then what you're gonna get, the strategy has to outperform my, let's say, I don't know, RSI2. My RSI2 is annualizing, let's say 50%. Well, your strategy has to annualize more than 50 to justify the complication. Because I can find many simple strategies that annualize around, let's say, even 25. But that's up to you. I'm not discouraging you. I'm just giving you the general idea.
Ayali, I should say something about it. In this week, I tried to come up with idea of trading retracements, because yes, RSI2 tries to trade basically the retracements. So I just tested an idea that was pretty close to Fibonacci. That it's super simple. It's just you identify the highest high or of X bar and the lowest low of X bars, and if you get a retracement on the close of this candle by X percentage between the highest and lowest on that X bars, to say it's something. I got super good results on the SPY by doing that.
But what you did is you used the a defined number of bars. So of course it can be tested, because for example here, let's say if I switch this to here, total all the levels change. But if you fix this as, I don't know, 20 bars, then you will always get the correct percentage. My problem is with Fibonacci or trend lines. They're subjective, because where are you gonna draw them? Well, you say, well, I'm gonna go with the lowest point. Okay, so this is the lowest point, and this is the lowest point, and this is the lowest point, and this one is also the lowest point. They all count. So it's now subjectivity. Now I say, well, this is too far. While so I might pick this one, but then maybe Chris say, well, this is already too far. This is the trend now. And somebody else might, shorter term, will say, well, this is too far. This is the trend. And that's why when you define it, like what you're trying to do now is, okay, give me the highest high, the lowest low over the last 20 bars. Well, now I can forecast what's the next 50% level or 61.8% level. Now I agree with you. Now it's programmable. You can do it. But to go just with the on the chart and how you draw them manually, that will never work. I mean, of course it will work if you torture the data enough, it will give you the correct answers. But I'm saying in what we do in algo trading, it doesn't provide added value. It might work. It's not like, that's what I'm saying. When you add these complications, the added value should be significant, just like we're adding filters. Yes, if I'm building a strategy RSI2 and I want to filter out for example, the regime. Well, the 200-day moving average, it's a significant addition. It's not just because I like it or because it removes one trade. It has to be significant. So same thing, you think of Fibonacci same way. The addition should be significant, that it's worth that you add it. I'm not saying it's wrong. I'm just, giving you the whole picture, that it is subjective. You have to program it in, and then you have to fix it. Just like you're fixing RSI, you're fixing moving average, just like you're fixing everything. It's just another degrees of freedom. So you say, okay, well, I'm going to use Fibonacci on 50 days. And then it will always give you the correct projection. Not the correct projection in order to be successful in trading. I'm saying to give you the correct projection to test, because it's always going to test the same methodology. Time zone and session times. So important thing in at least in bar timestamp. And of course we mentioned this, but now that we are recording the questions, this should be recorded for future. So a bar which has the open, this one, and this is the close. Of course this is an up bar, and this is the high, this is the low. That's how and let's say this is 8 a.m. to 8:05 a.m. This is a 5-minute bar. Okay, this bar will be stamped 8:05 a.m. in TradeStation. So TradeStation 8:05. Same bar, same everything, will be stamped at 8 a.m. in MT4, because MT4, not alone, with some other platforms, they stamp the open, and most everybody else, I would say 80% of everybody else, they stamp the close. So same information, they stamp the close. That's why, because SQX was a Forex platform when it started, trading only MT4 in the beginning. So that's why anything you build in SQX, by default it comes with shift -1, because they want to use, because at the open, because at the open you don't know the close yet. So when the price just open, you know the open already, because the bar is stamped with that open, but the close didn't happen. And if you say the close, then that's peeking into the future. So you need to look at the close of the previous bar in MT4. In TradeStation, you can always look at the close, because the close only happened at the close, so then you know the close. And of course you know the open, the low, the high. So that's why all my strategies, because I'm using TradeStation, I usually have no shift. And while by default it comes with shift. So what does that well, let's go another step. Also here, the timestamp, this is on the bar, and then you have another timestamp which is the exchange. So if I'm trading the ES, so let's say this is the ES, which trades on, this is futures, it trades on the CME, Chicago Mercantile Exchange, and they stamp their time zone, correct? Because it's traded on their exchange and that's the time. If you download data stamped with the exchange, and this would be in TradeStation very clear. So let's say, let me get the data here. You say edit symbol, and of course, if you are pulling data from a data provider, they will also have that. But see here, it says exchange. That's the default on all data providers. They usually provide you data stamped with their source. So New York Stock Exchange stamped their data at Eastern Standard Time. CME stamped their data at Central Standard Time. And London stamped their data at London time. Paris, and it goes on, yes? Each exchange stamp their data with their time zone. So if you download Exchange, and I download Exchange, and let's say you live in Australia and I live in Canada, it doesn't matter, because we're gonna be, our logic will be behaving the same way. If some brokers, to make it easier on their customers, like say somebody in Paris, okay, well, they don't care what time is it in US, and they want to trade this data stream in their time frame. So some brokers will change the timestamp in that time zone. So that will shift, which is exactly what's the question here. Yes, it's this guy is located in Germany, and of course, yes, there is this shift, this 5-hour shift. Actually, it is more, I think, because it's Eastern Standard Time in Greenwich is 4, and then 5 to Munich, and then time zone is 1. So it should be 6. I'm not sure, but you can check that. But yes, it will be shifted. So my 8 a.m. will be 8 plus 6 to you. So that should put it at 14. That's 2 p.m. So my 8 a.m. now is 2 p.m. in Germany. And then if I do close minus previous close at 8 a.m. and you do the same logic, if you shifted the time zone, of course it will not be the same, because then you are trading 8 a.m. Which now shifted 6 hours later. So your 8 a.m. now has a different bar. So if we put this, let's put this on the chart. And let me switch, let's say 60 minutes. So for example, this is my, what's this, 11:30. If you shifted 6 hours, this is my 11:30, but then this is, I don't know, 1, 2, 3. Let's say this is your, this is not obviously correct, but let's say if you shifted by 6 hours, this would be your bar, and this would be my bar. So obviously we'll have different outcome of the same logic. But if it's easier on you, it's totally okay. There is nothing wrong in shifting the time zone. You just need to know that, okay, the open in New York is now 2 p.m. It's not 9:30 a.m., which is the normal. So if you're trading, let's say stocks, let's say you're trading Amazon or Apple, they open at 9:30 Eastern Standard Time. Now they will open 2:30 p.m. in Germany. And that's totally fine. You live in Germany and you want to trade your time zone, and that's totally okay. You just need to be aware that that's what's happening. So if you want to have the same session times, then you need to do exchange time. So you need, regardless of your data provider, you need to make sure that the data you're downloading is downloaded with exchange timestamp, which is in all platforms it will be this by default, unless you change it, because you can change it to local. And this will be in all data providers also. They can shift the time zone, at least most of them, the one I deal with, but they do, yes. to make sure that the data is the same in SQX, so futures will be the same. But from my testing, Forex is not the same. I can tell you right now, Forex it's stamped with a time zone that is not New York, at least. That's the one I know. Because I tried it with same. I don't know what time zone they use, and I didn't go far beyond that because I don't use Forex like I use them on futures. But I tested Forex, which is a pair Euro USD, let's say, for example, and TradeStation data completely unmatched the Dukas copy data, which I am assuming Dukas is stamping Swiss time zone, because that's only natural. Yes, they are in Switzerland and they are providing this data, and they should stamp it with the. So with futures, I wouldn't worry about it, because I can tell you that SQX data is stamped with the exchange. So if you import data with the exchange, that should be the same. But for Forex, no. Of course, stocks also are stamped with the correct time, because again, they are stamped with the exchange.
One question. If I move, let's say, to China, and if I open TradeStation in China, I have another time zone, China. So should I change the time zone stamp in XQX when I import the data? Because you said in the Discord that I should put like GMT -5, something like that. So that's my issue, my question.
It's up to you. You just need to understand. Like, there is no right, wrong methodology here. You just need to understand what you're doing. So I am in Eastern Standard Time, correct? My TradeStation, if I switch to local now, nothing will change, because both of them are because I am in Eastern Standard Time, and the exchange for example, let's pick XLI is New York. So let's check something. This is the exchange. I am Eastern Standard Time, okay? So let's pick, I don't know, let's pick this one. So the high is 105.38 at 16. Okay? The high is 105.368 at 16. We go to local. It reloaded. The high is 105.38 at 16. Nothing changed, because my local time here, it is in Eastern Standard Time, and of course this is stamped with Eastern Standard Time, so it's the same. If you are in China, and let's say this is -12, so now when you switch to local, this 1600, the timestamp, the open, high and low will not change, but the timestamp, instead of 16, it will be plus 12 hours. So it will be 6 a.m. tomorrow, this timestamp, because you are in China now. So the data is still the same, time change. So that means if you build strategies that trades the open on New York, now the open on New York happening at not at 9:30, it's happening at a different time in your data. That's the only thing you need to worry about, is when you're doing your logic, assuming you're doing intraday. If it's on the close, it's on the close. Nothing much will happen. But if it's intraday, where the time makes a difference, if you're trading at 10 a.m. or 2 p.m., then your time zone change, and you need to understand that so you can build your logic on that. Just think of it this way. If I'm trading the breakout from the open, say this is the open 10 a.m. So bars here, and I'm trading the breakout, yes, either down or up. In New York, so my 10 a.m. is the same as trade station 10 a.m. In Germany, I need, assuming let's say we are trading Amazon, okay? So I am from 9:30 to 10 a.m. That's my window to measure the breakout. I am trading in New York. If I move to Germany and I'm trading the same strategy and my data is stamped with exchange, then everything is the same. Nothing will change because the data will be still 9:30 to 10 a.m. This is exchange. But if I switch to local time, so now I need to change my starting time. If the difference is 5 hours, I need to add 5 hours to this. So this would be 2:30 p.m. to 3 p.m. My logic now, when I put in StrategyQuant X, Algo Wizard, when I go on bar and time, when bar time is, it was 10 a.m. in New York. This is my logic. If I move this logic to Germany while trading the data that is stamped with local time in Germany, meaning this has switched to local, then I need to change this. RSI is the same, but now my bar time is not 2, now my bar time is 3 p.m., which is 15. Okay? But if I'm trading in Germany using exchange time, then my logic is the same. It should work. It knows that 9:30 is still 9:30 Eastern Standard Time. So time zone is only to make it easier for the person living in that time zone to match. Because imagine you are in China and it is, I don't know, 9 a.m. your time, and the chart shows it's 6 p.m. yesterday. It's confusing. So the time zone shift is there to make it easier on you to read. And then of course you need to take care of the logic. Of course it's easier for me to say this, but I always use exchange time, even when I was away from Eastern Standard Time, because I know what time they open. Like it's ingrained in my brain. I traded so much using the time zone. I know the activity. I know 10:30 there is a flip, so it's a lot easier for me to stick with the exchange time. But I'm just saying it's a choice. You need to do it. Of course, it's going to be a hassle to maintain because if you shift the data, then you need to have a provider that shifts the data for you. Because if you do it manually every time, most likely you're going to do some errors. As like anything else, if you need to automate the whole thing to make sure it's stable. So I think the best way is to get the data from a data provider that's already time shifted, if you want to go that route. Otherwise, just use the exchange.
About importing the PlayStation data, you said -5 is just because it's in Eastern Standard Time?
You always use exchange. That's the default one. If you want to shift it, then you can shift it here. When you import data here, when you say use -5, it's already -5. That's the exchange stamp. That's not you adding shift.
Because if I import data, the exchange doesn't appear. There's time zones. There's no exchange.
No, it's figuring out the time zone from the data. That's why when you put it on auto, it will bring -5. So -5 is not shifting. That is the actual timestamp of Eastern Standard Time. So Eastern Standard Time is -5. Yes, Central Standard Time -6. So these are actual values, these are not shifted. Because Greenwich is 0 and EST is -5. So the SQX figuring that out automatically. And so you don't need to do anything. When you export as exchange from TradeStation, just import, don't change the time zone, don't change the daylight, just leave it as is and it will be okay. Okay, so this question, the problem is, first of all, he talks about if you have a stop loss and a profit target and you're trading daily bars, which one will hit first? Which is a good question. So say you are trading intraday. So this is the daily bar, and let's say this is 1,000 and this is 950. So say you entered here, I don't know, let's put this in the middle, 975, and let's say your target and your stop loss are $20. Okay, so this is $20 stop loss and this is $20 profit. If you're testing on daily bars, you don't know which one hit first, and I actually don't know which one StrategyQuant X will pick first. So, but if you let's say you imported this, it's in Excel or whatever, or it's manual, you should always assume it hits the stop loss first. That's the safest one, safest choice. But of course, to test it properly, then you need to go intraday. So for example, I don't know, this, let's assume this is intraday. Okay, so this is the same bar, this is the same high, same low, so this is 950, 1000, and we can see here that we hit the stop loss first and then we hit the target. So if I test on 1 minute bar, I will get the correct answer to this question. If I'm using ATR, which is, that's what I answered him, I think. If I'm using 2 ATRs, let's say 2 ATR is my stop loss and profit target. That means what? That means I am putting twice the average move per day as my target. So if the average move like this was $50, then my target is somewhere here. So it is $100 here and $100 here, below this, yes? So this is below and this is above. And when you're using 2 ATRs or more, it is extremely hard to hit both at the same bar, because then it is not 2 ATR anymore. Well, now it is around 3 ATRs or 3.5 ATRs, depending on where the bar starts. So it's very hard now to have a bar that it's not impossible. I'm just saying improbable. That when you have 2 ATRs or more, it's the probability is extremely low that you will hit both on the downside and on the upside. So it shouldn't be a problem when you have this kind of target. It is a problem when you have this kind of target, which is inside the bar, which of course definitely gonna hit both of them. And so you just definitely need to test on 1 minute bar. This is 1 minute. So you definitely need to test on 1 minute bar to find out if it hits the profit target or the stop loss. The other part of the question is the strategy have a huge difference when you build it using TradeStation engine and MT5 engine. This goes back to this one. So like I mentioned, if you use the close without shift, MT4 is speaking into the future. So with MT4, you need to use shift. So for a strategy like, which I put this example, a strategy like RSI should not have a huge difference. It's on daily bars, and I put here shift 1, and I can show you. So this is running full test, shift 1, 391 trades at 488 return to drawdown. If I change this now to 0 and go to TradeStation, I am still in TradeStation. So 391 and 488, 391, 427. Okay, the strategy didn't change much because I am picking a longer period that theoretically, as part of its robustness, if I go the close 1 bar ago or 2 bar ago, should not affect my strategy a lot, because this strategy is robust and this shouldn't matter a lot. So if I test this 0 and put the engine now on MT4, and now of course I have to switch this to shift, again I should not expect a lot of change. So 391, 427, 387, so that's 4 trade less, and 417. So very acceptable. Yes, the strategy is robust. I use it now correct both ways. Once I introduce a condition that depends on this stamp, so for example, let me use the close of today. Let's just use the close again. So close of today greater than the close of yesterday. Okay, now of course this will have a huge effect. Yes, now I have a condition that today is greater than yesterday. So I'm using now MT4, so this should be shift 1 and this should be shift 2. Now let's test this. So I have 67 1.11. If I change now this to TradeStation and shift everything back, should be big change. At least I'm assuming. 67 1.11. Yeah, see, it's a huge change, because the timestamp has a huge effect now, because now I'm depending on, it's not robust anymore. I am conditioning based on this. So if I missed the last bar, then I missed that trade at all. Now that trade is not valid. So it has a huge effect. So what's the conclusion? You are not going to trade on the MT4 and TradeStation. At least I hope you're not, because you need to niche down. This applies, of course, to the whole concept of trading. So in trading, there are, literally 1,000 ways to make money. You don't want to be like, the expert in breakout and the expert in mean reversion and the expert in tactical asset allocation. That will not work. You only have finite amount of hours, finite amount of dedication. So you need to specialize. At least be good in one and then average in the others. And of course, this will go to the platform. Each platform like SQX, TradeStation, MultiChart, MT4, MT5, each one, they have their own nuances and their own, idiosyncrasies, and it's small things like, rolling futures. It's different from one platform to the other. Each one has like its own tricks, and you know this because I have many videos on the channel about SQX tricks and tips, and because you're getting better at SQX. So now you have to decide, well, which platform you're going to use to trade. If it's TradeStation, that's good. Then you should now focus on learning TradeStation. And if it's MT4, then also that's good. Do not focus on making everything work in MT4 and in TradeStation. That's like just a you're adding pressure for no return. Yes, you're piling up pressure on yourself and more time to dedicate to learn both for no significant return on your side. That's the problem that the SQX team spend on. They always need to make sure that whatever they develop works on all these engines. You need to worry yourself with one. And that's why you don't see I don't do training on MT4 because I don't use it. I don't plan to use it because it's the same problem with me also. Yes, I only have finite amount of hours to dedicate and I don't plan to learn MT4. It's not, I already know TradeStation. I don't even have time to jump into MultiCharts, even though it is better than TradeStation and I have it, but I just don't have the time. So that's a decision you make. Once you make that decision, then you need to understand that platform and its nuances. And the first one you will learn is this, which is MT4 stamps the open. And that's why you need always to use shift. You cannot use shift 0. This should always be 1. Okay? 1 or more. But 0, it doesn't work. Open 0 will work. Because remember, at the time of the open, so we go back here. When I get this bar open, I know the open. That's correct. I'm not peeking into the future. Because that's what MT4 stamps. And then of course you will use the engine. So you'll use MT4 engine. And also when you export, so when you go here as source code, you need of course to export MT4 engine. And SQX, I think they added this a while ago. Like if I pick now, it will give me a warning signal because they know this engine is not, the strategy is not calculated with MT4 engine. So they give you this warning before export. Of course, if you're doing this automatically, then you will not see this warning. So you just need to make sure that you're always using MT4. The good thing if you are an MT4 platform user is, like I mentioned, SQX was built on 4x MT4. So anything by default is for MT4. If I pick new, it will automatically, look at this, it will automatically be MT4. And if I put any condition, by default is shift. So let's pick daily open. See, it's automatically shift. Daily high. Anything is automatically shifted by 1. So if you're an MT4 user, then by default the platform is suited for you. And you just need to make sure that, you know, it is there. And that's it. Now, okay, so you got this, you got that part. Let's say now you say Ali is full of crap. I want to test on both platform. I want to test MT4. I want to make sure that it matches TradeStation. I can tell you right now, it is rare that any strategy you bring from SQX match 100% TradeStation or MT4. Okay? So it's even, of course, even more rare that MT4 will match TradeStation. And why is that? So SQX has all these indicators. And when you install SQX, it tells you to import those indicators into TradeStation. Why? Because SQX sometimes not cheat, let's say they have a better implementation or a worse implementation of an indicator. So for example, I'll give you a simple example. In TradeStation development environment, you can decide if the variable is high resolution, meaning let's say it has 10 decimal places, or low resolution, which has only one decimal place. And why is that? It's because at the time TradeStation was built, computers were not so powerful. So they give you the chance not to overload the CPU with calculations. But of course it still happens. And let's say SQX came up with a better way. So for SQX, let's say if the RSI instead of 20.1 is 20.2, that's not a big deal. And so they wrote that indicator separately. So when you go to TradeStation, you will have many indicators that's already available in TradeStation, but now they have their counterparts in SQX. So for example, let's say the exponential moving average in TradeStation, which is available. You can also, you have another indicator, which is the exponential moving average from SQX, because SQX used that differently, in a different way. And that will generate some differences in the results. Now, as usual, you need to know that the difference should not be extreme. Like a strategy that makes $100,000 in SQX, you port it over to MT4 or TradeStation, it should still produce around the same profits. A little bit more, a little bit less, 2% more or less, it's nothing. Yes, that's acceptable. But if the strategy is profitable in SQX, you port it to a TradeStation and now it is $50,000 instead of 100. Something definitely is wrong and you need to check that. Don't throw the strategy away. Most likely it's some setting that you missed, like time zone, session, end of day, like you're using es.d instead of es. There are many things that can go wrong. But it's not impossible. It's rare that the strategy will match on both ends in both platforms. And of course, I wouldn't worry about at all matching MT4 with TradeStation. Okay, Mosey. Holdout period that said the main point of avoid overfittings, don't optimize for holdout period. So the way I use holdout period is, so this is the data in sample out of sample, and then the strategy, let's say this is in sample out of sample. The strategy pass, you go to SPP, the strategy pass. Now you need to test this strategy on the holdout period, which is something here that we didn't see. So usually, let's say this is 2000, 2018, and this is 2018 to 2021. This is, let's say, to make it 17. Okay, that's the holdout period. If your strategy didn't see this data, and say your strategy trades all market regimes, it's all even on all market regimes just to make it easy, so it doesn't matter what the holdout period regime has. So say your strategy here is, I don't know, 1.4 profit factor. You bring it, you test it here, it's 1.3. That's it. This strategy is good. It's done. You can trade the strategy. If the strategy here is 0.9 profit factor, again, that's it. The strategy doesn't work anymore. So there is no overfitting. You're not overfitting this data to this data. This data is not seen. How can you overfit for it? So that's number one. Number two, I've heard somebody. This makes me laugh. What do you think about separated SPP and do multi-SPP after full SPP? in different period and compare them. There is a way. So the Walton, the guy who invented SPP, he has actually another method to do it. So he used stochastic. It's just like doing Monte Carlo on SPP. That method is not implemented anywhere, at least that I know of. So obviously that's better, but we don't have it. So that's the only way I know you can do it. So if you have another way to do it, I don't know. I haven't tested it, so I cannot say anything about it. But I know that Walton has the other methodology, which of course can be programmed. I mean, all this can be programmed. I'm saying it's not available in a retail package that we can buy and use. Our only bet is that SQX implement this, because at least till now, nobody else has implemented. And TradeStation, all these trading platforms, they're not going that route. They are going the route of adding more indicators and making the charts beautiful. And we lack algo trading platform and portfolio trading platform. According to Clonex, complexity, number of trades are important things. Backtest, avoid over that confuse. DO of degrees of freedom, that's calculated. Yeah, so actually even Clonex doesn't know the answer, because I asked him this, and the Mark is the one who implemented this. Okay, so we don't know how they are calculating the complexity. But in simpler terms, let's say each variable count as 1 point. So if you have 3 variables, that's 3 points. But of course, it's not as simple as that, because the variable alone can have different variations inside it. So yeah, I don't know that. Of course, degrees of freedom is mathematically easy to calculate, and I will put the formula for that. It's from Robert Pardo, and he has it in his book. So I have the book. I'll put the formula. This is my point of view. Of course, you are entitled to have your own. My point of view is don't complicate things. Okay, in the beginning, at least in the beginning, just focus on making money with simple strategies, because this is a never-ending journey. It's not like, you will read this book or you'll take this course and you will learn everything about trading. No, it will never be like this. There is always something new. There is always new markets, something new to learn, another addition to add, another strategy, another portfolio, another platform. It's always changing. Of course, that's what makes it exciting. So, but after going the extreme way, like I went from nothing to extremely complicated, and now I am back in the middle. This took 14 years, but I can tell you right now that complicated is not worth it unless you have a team and a lot of capital. What do I mean by that? So in hedge funds that I had relations with over the past 3-4 years, they use totally different strategies because they have huge capital and they have really, really good programmers. Okay, so a C programmer makes like $250,000 at a hedge fund, and not because they like him, because he provides value. Yes, that value is what is returned to the hedge fund. So of course everything they use is complicated. It's like all it's over my head. I mean, I see these equations and I cannot even read them. I am a computer science. I have a BSc degree in computer engineering, and it's beyond me. Okay, so but of course it's making money. The guy told me, like, they make at least $50 million from this only one program. So there is money in complication, but not for us, because you need a team. Why? Because you need somebody to build the systems. You need an IT guy to make sure everything is up and running near the exchange, and you need programmers to debug your code. So one programmer will never work because you can always miss something. And we've seen this happens where some programs get launched into the market, and last time Night Capital, I think they lost, I don't know, $250 million because the program was something wrong was in the code. So it does happen. So after going that route, I came back in the middle, and in the middle there is a lot of money to be made, so I don't worry about it anymore. But I totally understand that people get curious, and that's your own journey, so I cannot say no, don't do it. That's your own journey, and but I can tell you that all the information you seek is available, and it will only increase the time you're gonna spend to learn code. Of course, if you're not a coder, then forget it. There is no point in getting this complication anyway, because you will not be able to test. The only way to test is if you can code. So if you can code, you can learn all that. And I remember who's here, Oliver. So Oliver, usually the questions I get from him is always in that direction. So some people have this it's more interesting for them to go that route, which is totally fine. I'm just saying, in the end, if you're not a coder or if you're not planning to learn to code, then adding any complication, it's not worth it. Stick to simple strategies and don't worry about degrees of freedom, or just make it simple. Simple is what? Is 1 or 2 conditions to enter, 1 condition to exit. That's it. And you can easily fix that in SQX or any other platform. And finally, for money management, I use fixed percentage. Comes from risk of ruin calculation that based on win rate average PL. According to the trend following strategy is not reasonable because low win rate. So a trend following strategy, because of its profile, will not work alone. So you see the distribution is like this for trend following. It's usually but the middle line is here. That's the profile of a trend following strategy, which is a lot of losses, small losses, some big ones because of market shocks, and some huge ones in profits. That's what makes money here. So if you trade one market, this will not work because you might not catch this in 10 years. So you definitely need multiple markets. And then when multiple markets, of course, you're going to need more capital. And that's your restriction for trend following strategy. But for other strategies, short-term strategies, when you do the Monte Carlo testing to find out the capital needed, first of all, you definitely need to do it without any money management. That means you need to do it with fixed number of shares or fixed contracts or fixed lots, because you want to find out that threshold, where that threshold sits. And also I recommend, this is maybe a little bit more advanced, but we are here anyway. So say you say your strategy makes 50K using one contract, and you find some position sizing that takes this to 250 and maximum 10 contracts. You need to pick a line. Say you're starting with what is this, 2550. Let's say we're starting with 20K. I recommend usually that you don't start with a position sizing until you are double your position, your starting account. So let's say you keep trading like this, and then once you are at 40K, then you start implementing your position sizing. That will give you a buffer that unforeseen shocks, because for any position sizing algorithm you're going to use, it will amplify the profits and the drawdowns. So when you do the testing on one contract, let's say the drawdown is 20, when you do it with position sizing, it will be amplified. And so you want to have this buffer. So instead of starting from zero, even if you tested and risk of ruin is 2%, 1%, or 0%, I would implement this strategy. It is double your account and then implement your money management. So money management is the same thing as position sizing. And I read they suggest to focus just mean reversion strategy for, yeah, so not so you need to understand this as a so trend following is long term. If you pick 60 days, let's say trend following, or 120 days, you can imagine you're not having too many signals. So a trend following targeting 10% volatility will have 10% return. So, you know, if you have $10,000 in your account, which of course you cannot do trend following, but let's say you're trading, I don't know, micro lots. Your expected return is 1,000. And of course you don't want that. You want many trades to grow your account rapidly. So then many trades comes from shorter time frame strategies. And that is short-term trend following, which is called breakout strategies, and mean reversion strategies. Of course, there are many more other strategies, like, for example, pair trading, gaps. All these are also short-term time frame. And you should implement that in your portfolio because they trade a lot, and hence they will increase your profits a lot because you want to grow in the beginning a lot. So it's not the style, it is the time frame, because so time frame is the more important one, because trend following works on also short time frames. You just need to have, it's a different flavor of trend following. Short time frames, meaning you have profit target and stop loss and, you know, all that fun stuff. Okay, and the follow-up from Fortune, my rules for Fibonacci are following a specific swing after a new low has formed and after the next high on the current time frame. Totally fine. I mean, I'm still with you. It's just you need to fix it. So let's say you mentioned a new swing low. So a swing low is a pivot, meaning this is a pivot, yes? But would you say this pivot is good enough? This is also a pivot. Let's go to time frame to see more. So this is definitely a good pivot. But also this is a pivot, which when I look at it, this doesn't look important to me. This is important. This is important. So that's, again, we back to subjectivity. Even like I have a zigzag indicator on TradeStation that prints, like I tell you, this is a pivot, yes? But even then you need to decide, okay, well, how many bars I'm going to look back and forward. to decide this is a pivot. So you can say, well, if it's a pivot is continuous 5 bars that has a lowest low in the middle or a lowest low in the last bar. That's a pivot to me. Like, you need to define what's a pivot. So again, this is totally fine as long as you can fix it. Because if you go just by looking at the charts, you will mix many patterns, you will lump them in the same category, although when you define them mathematically, they will not. Okay, and I use in my trading software VPS and local related PCs, including TradingView charts, the exchange time. Local exchange, then there is a midnight. I can get offset to the never changing UTC time. So I think you are in the US, and that's it. You should stick with exchange time. Unless, like, what, you're trading with a European broker and they have a different timestamp. That's the only time I see that you're gonna need to change the time zone. Because remember, exchange time will also change in daylight saving time. So next November, next weekend, or the one after, I think we're gonna change to daylight saving time. So of course the exchange will change. So 8:30 will still be 8:30 after daylight saving time. So though crypto, I have to trade in UTC. Yeah, okay. So crypto, because there is no exchange. Of course, there are exchanges like, Coinbase and Binance. They're on opposite end of the world. So their timestamp is there. It's them now, even though there is no central. So it's like Forex. With crypto, just think of it like Forex. Each provider will have their timestamp on it. So if you're trading with Binance, they will have, Hong Kong timestamp. And if you're trading with Coinbase, then they will have Eastern Standard Time timestamp. So crypto is like Forex, everything else is exchange time. Again, this is not a good or bad. This is what works for you. But just you need to understand when you change the time zone, you need to think of, okay, what's the open now in US? 9:30 a.m. in US will be, I don't know, 2 p.m. in Germany, and it will be 8 p.m. in China, and so on and so forth. You just need to know that. There is no right or wrong. You just need to be aware of it. So when you build algos that use that time, that bar time, then you can program it correctly. Otherwise, there is no right or wrong. It's whatever works for you. From my experience, don't add more work unless it is adding a significant return to you. So if timestamp is a hassle, you need to update indicators, import, clone it in SQX, blah, blah, blah. If it's a lot of time wasted just to make it easier to read, I wouldn't worry about it. I will just use Exchange. But if all that is making you more money or making your whole workflow is easier, then I will definitely do it. You mentioned before that you use regime filter. Is that on strategy creation or just on money management? No money management. So money management is, to me, and online also, like if you read it in books, money management means it means position sizing. Yes, you are managing how much money you give or how much risk you allow per trade. So regime filter does not affect that. It can. So So for example, let's give me an example. Let's say your strategy. So let's say you have a strategy, and let's pick a simple regime filter. So let's say this is bull and this is bear. So you have only two regimes. And let's say your strategy makes $500 here and $50 here. And say your strategy is 70% profitable here and 50% profitable here. Okay, so I built my strategy. This is the market regime it's in. So I can now use my market regime as a position sizing. I can say, okay, well, here I am 70% more profitable. I make more money on average per trade. So every time I am in bull market, let me trade 2 times my my fixed. So let's say you're trading here 100 shares. So in bull market, I trade 200 shares. And since here I'm only 50% profitable and I make less money, let me trade half my fixed shares. So if I'm trading 100 here to start with, here I will trade 200 and here I'll trade 50. So then here market regime can be used in position sizing. This again is an advanced subject. You don't need to worry about it right now. But answering the question, yes, it can be done. But it has to be significant. So I don't use it unless it is significant. Although, by the way, I don't use it on the strategy unless it's significant. So I don't put market regime on every single strategy. If market regime is benefiting the strategy, then by all means, this benefit has to be significant. Always. Anything you add to the strategy, any filter, any position sizing, any stop loss, they always have to be significant. Otherwise, you're adding complications, more degrees of freedom, without getting the return for it. Okay? So it's always not to add anything, but if you're getting significant return from it, that significant return could not be only profits, it could be lower drawdown. So for example, my strategy, let's pick this one again. And let's say my drawdown here is let's say 50%. And my drawdown here is 25%. Well, okay, 50% is a lot. In that case, I will eliminate, not trade the bear market at all. Or maybe do this at 25. So 0.25 position sizing instead of 1. Because even I'm not worried about making money now. I am worried about just not facing this drawdown. So significant enhancement can be in many things. Can be more trades without affecting the average profit per trade. Can be lower drawdown. Can be higher return to drawdown ratio. It can be many things. It's significant enhancement to the strategy, or significant enhancement to the portfolio. I can tell you right now, if you're trading the S&P 500 in a portfolio, obviously the market regime above 200-day moving average will benefit your portfolio as a whole, regardless of what strategy is inside it.
Ali,
Yeah.
It's Aliko here. Yeah, just quick question. You mentioned that Clonex has created a market regime indicator for you. Okay, so are you using it in live trading, or is it just on when you're building strategies?
No, of course it will be live also. You need, if you're building in SQX, when you export the code, we don't have any strategy here. Nothing here yet. So when you export the code, it will say, StrategyQuant market regime. Well, of course, if you bring that into TradeStation or MT4, that doesn't mean anything. So of course the code has to be again in TradeStation and SQX in order for you to trade it live, because you want to have it in the live strategy. If you develop the strategy with a market regime and it's robust and you want to trade it, then of course you need it. And actually he just sent me, I think 2 days ago, he sent me the MT4 version. So yeah, so the market regime in 20 states, I have 20, you can go from 2 to 20, and it's all now working SQX, TradeStation and MT4. So that's done, which is good. I still have one more indicator from him in SPP, but it's not being implemented yet. He still cannot do it. They're waiting for some update in SQX, and then he said he can do it.
One question about the market regime you have developed. As far as I remember, it's based on ADX, as if I can recall. How do you come up with the idea of having like a fixed setting on ADX? How do you come up with that, like one setting? Did you test it across several markets? What's the idea behind it?
So excuse me. So my market regime is not based on ADX. What happens is somebody asked me and I said you can build your own, because I don't want you like to have this I don't want you to have a a crutch. Okay. So you can build your own market regime, which of course I use many on the channel as the moving average, correct? So moving average can be, so let's say this is 200 and 150. So this would be bull, sideways, and bear. That's a market regime. 200 SMA, 150 SMA. If the price is between here, that's sideways. If it's above bull, if it's below, it's bear. Same thing with ADX, of course. Same thing with ATR. So you can design your own. The only problem with these kind of ways is the same as what we went through with Fibonacci. It's subjective. So, for example, you will say, well, 200, 150 is too slow. I want a market regime that is faster. So maybe I will pick 180, which of course will work on faster market. So same thing with ATR again, same thing with ADX. You basically, market regime is what? Is a direction and volatility. That's the components of a market regime. So while most of us use market regime wrongly, but the regime, market regime, is a direction and volatility. It's a combination of both. But volatility. But most of us use, for example, I do also on the channel, I'll say, well, if the market regime is bull, but that's actually not the market regime, that's market direction. Okay? The regime has two of these components, direction and volatility. So direction can be measured in many ways. SMA, momentum, RSI, and also volatility can be measured in many ways. The thing I did is there's something called normalize. So you can do this on any indicator. Basically what? So you know the RSI goes from 0 to 100. It doesn't matter what data you show it. Intraday, monthly, Bitcoin, crude oil, Amazon, it will plot from 0 to 100. Why? because this is normalized indicator. A lot of indicators are not normalized. My market regime is normalized. That's the advantage I have over any other indicator. That means if you throw anything at it, 5 minutes, monthly, Bitcoin, ES, it will tell you if you are in a bull market, bear market, sideways market, and what's the volatility. So it has 5 states for direction, which is sideways, bull, extreme bull, and bear, extreme bear, and 4 states for volatility, which is very quiet, volatile, very volatile. I just showed you how you can do 3 here. Yes, you can do bull, sideways, bear. Of course, you can extrapolate and say, well, okay, now I do 60 and 120. And now I have extreme here and extreme here. That, you know, it doesn't work all the time because then these guys cross and... But anyway, I'm just giving you the idea. But how did I come up with this idea? If you spend a lot of time in something, your creativity will start to, work. That's what I said in the beginning. Like, it's better to niche down on something instead of being average on a lot of things. There's nothing wrong with that. I'm just saying in the long term, you should be excellent at one thing. And then it's okay to be average at the other things. And so, yeah, that's how we started. And like it didn't develop in one time. So I started with direction, and then I started with volatility. One didn't work. Then I read another book, which gave me another idea, and I implemented that, and it was working. But when you switch to shorter time frame, it didn't work. And then I experimented and came up with something and kept testing it. It's what's working. And then I stuck with that version. So, but usually if you have the right, let's say now you have some good foundation in something, then an idea from somewhere else might spark better development for you on your foundation. So that's how I can make it closer. Okay, B Trader, you mentioned that you use regime filter on. Yeah, we did said that. Where is the delay entry option on day bar trading? It's the shift. So this one. So this is on this bar. You're looking at the previous bar. That's what you are doing. So it's not a delay. It's you are looking at previous bar. In MT4, you always have to do this. And because, like we mentioned, because of the open is the bar is stamped at the open. In TradeStation, you don't have to, but you can always look at the shift. Also, by the way, you can shift in the future. So you cannot do it here in TradeStation. You can shift your indicator. Say you have the 200-day moving average. You can shift that in the future and then use it as a calculation. So, which is of course same thing as looking at at 3 bars ago. It's just a convoluted way of saying looking at previous bar. So anyway, but this is not a delay. You can delay the signal. That's a totally different thing. So delay means this. Delay is, say you're trading here, say the price penetrated bull. Instead of taking this signal now, you take a delay of 3 bars to see that the price did not pull back. Which again, the interpretation is shift. So that means at bar number 5, you're looking for the breakout and the pullback. So all of them leads to the same thing, which is your calculation looking at some bars ago. And BTrader again, I know already. I thought there is no other option. Regime detection. Yeah, so there is no, I mean, this is not my idea of regime detection. So BTrader asks, there are research and there are actually indicators on regime. And each one define it separately, of course. This is my own definition. But just to let you know, in hedge funds, they don't use this. They use, I mean, unless they are short term. So long term hedge funds, for example, they use market regime as from the macro side, which means what? Which means they take interest rate as market regime. So currently we are in a low interest rate environment. That's a market regime for a macro trend, because macro trend, they don't trade like us. They take big positions and they say, well, in this regime, low interest rate, printing more money in inflation, Canada dollar will be stronger than the US dollar. Okay? Canadian dollar will be stronger. Why? In this regime, because Canadian export minerals, they export oil, and and that price in dollars. So because dollar is being inflated, low interest rate, so this theoretically should inflate the Canadian dollar against the US dollar. So from that macroeconomic point of view, in this market regime, we will go long the Canadian dollar, or we will buy the TSX, which is the stock index in Canada. And that's a macroeconomic view long term. And so they use the interest rate as the market regime. They don't use the whatever, the moving average or the ATR. So to different people is different interpretation, this market regime idea. To short-term traders, I can tell you that my implementation is really good, because it works on short time frame and daily time frame, and it works for short-term trades, which is 3-5 days holding periods. And even in long-term trend following, of course, you will find that short-term short trades doesn't work that good anyways. So, and they use the moving average already, so they're already using direction, and their ATR stop loss, it's already volatility. So trend following already have this market regime built into them. Just to add also on the market regime, of course I have it for a long time, I know excuse me, I know it works, but it also doesn't work all the time. You need to keep this in mind. This is just like any other indicator. So it works a lot of time, and a lot of time it doesn't work. What I mean it doesn't work, it doesn't add a significant value. So I can enhance the strategy by going, let's say, from 55 to 60% win percentage, but I lose, let's say, third of the trades. So in that case, I don't use it. Yes, it does enhance the strategy. Like it's a, it's a balance. Yes, you need to find the balance, that if this adding, again, it's all coming back to the same thing, which is, can you add significant value when using whatever you're adding to the strategy? So most of the time, the market regime helps, or one of them. Sometimes only the volatility helps. And especially with mean reversion strategies, you find volatility helps a lot, as a filter. And so yeah. So I want to reiterate, it's not a compulsory that you must have this to get a profitable strategy, but it's really a nice addition to your portfolio, because it's the driver that comes from these two indicators are different than from your RSI, for example. So he's asking about hedge funds. Hedge funds are really interesting, and I was fortunate because before I sold my business, I invested with hedge funds. And, it's a personal relation usually. This is, lately. And in the 90s, it wasn't like this. But in the last, I would say 10 years, it's a personal relation, and they are not afraid to give their methodology anymore. In fact, they're so transparent. It's in their literature. So nowadays, let's say you have, whatever amount of money you want to invest in a hedge fund, you usually sit with the manager and they tell you what they do. They tell you, well, look, I do, this strategy. They don't give you exactly, let's say they are doing trend following. They don't tell you I do 120-day breakout, but they tell you I do, multiple versions of trend following. I mix it with this, blah, blah, blah. So you get to know, of course, if you are already a trader like me, let's say, so a simple hint will give you back the, he will know, oh, he's talking about this, okay? So, nobody taught me how to do pyramiding. From talking to them, I figured it out. Because I built trend following strategies. And then from talking to the top guys, and they say, oh, okay, now I know how they pyramid. They don't go with one breakout. So they go 100, 75, 50, and then 125, 150. That's how they pyramid in, pyramid out, by using different speeds. And so that's how I picked up. But then in the last 2 years, because I want to start my own hedge funds, so then I went deep into this. And again, I was fortunate enough to have people that let me in, show me what they are doing inside for, different reasons. One of them, I gave them some systems to trade, and in return, they gave me their platform to use, and I get to know their programmers, blah, blah, blah. Of course, you have NDAs, and so they're not stupid. I cannot talk or trade whatever they do or say anything, but I can say general things. And so what they do is usually is not what we do. Not because what we do is wrong, because usually they have a lot of capital and they need volume. So for example, I have breakout strategies that trades one day. So it takes a breakout at a certain point in time, and then it exits next day. Well, they cannot do this strategy. Doesn't matter how profitable it is. There is not enough volume in it that they can put 50 million behind it. So they will not waste their time with what they call illiquid strategies. So it's illiquid for them, totally okay for us. Even ES, which is the most liquid futures on the planet, intraday strategies for hedge funds is not easy. There are a handful of hedge funds that trade intraday, and they are high frequency trading hedge funds. But the rest, they don't touch intraday. And it's mostly I would say 95% of the time it is liquidity issues. So that's why they need long term. So that's the main difference. You would say, because they entered the position over a week. Imagine, say RSI2 is working for us. Well, they need a 1 week to build the position to get into the trade, because they have 100 million, let's say, to build. They don't want to affect the price. That's one. Number two, they are extreme. The pendulum is extreme between hedge funds, between their strategies. So for some of them, really long term, trading 150-day breakouts, macro trends, and some of them are really trading the order workflow. This is not high frequency trading. So some of them trade strategies that we cannot do. Okay, so I'll give you an example. Arbitrage, stat arbitrage. This is very popular hedge fund strategy, which is arbitraging the futures with the component of the S&P 500. Many hedge funds do this strategy. Okay, of course we cannot do it because first, we don't have the hardware, the speed, and the capital to do it. And so there are differences. It's just keep this in mind. That doesn't mean is what we're developing is not working. It's just it doesn't work with volume. That's why I mentioned this on, I think, one of the questions and answer sessions. You can easily double a $10,000 account or a $50,000 account. Once you are at $1 million, now it's going to be very hard to double that account, because the same strategy that made you double your account at 10,000, you cannot trade it now anymore. Or you can trade it, but you cannot trade it with the volume extrapolation. Like if you traded one contract at 10,000, you cannot trade 1,000 contract at 1 million. Again, going back to the ES, if you trade, I would say 500 contracts is okay, but more than 500, now you need to spread it over, I don't know, 4-5 minutes intelligently. So, and this is the most liquid futures contract. So, yeah, I would say liquidity. Just keep this in mind, liquidity. No, Renaissance currently nobody can replicate. They are on a planet on their own for the past 20 years. And this is to the relentless pursuit by Jim Simon, and also because they made everybody a partner. So the idea is not going out. Usually, like somebody like, let's say, Goldman Sachs. So that's how it happens. Some genius come up with an idea because they have all the resources in the world. They can implement that idea with lots of capital. They sign NDAs, blah, blah, blah. Then, their period finished. Let's say the lockdown period is 5 years usually. They go out, they don't replicate, but they come up with a similar idea that doesn't conflict with their NDA, and the strategy gets out. Yes? With Jim Simon, he made everybody a partner. So now nobody, like, what's the point of getting out? You're already a partner here and you're already locked. So the idea did not go out. Although from all the research done on Jim Simon, it is just what I told you. It is start arbitrage, but it is like on what's fuel? Let's say it's on, I don't know. It's on some kind of hyper fuel. Okay, so many strategies, like I mentioned on Wall Street, does start arbitrage. Their returns in the 20s. Okay, they do like 25-27%. Like D.E. Shaw is also a math genius, also doing very well, sometimes in the 30s. but nobody comes close to, like, look at this. It's 25 and then 60. Like it's bound and like leaps and bounds above the best. So I don't know, and it doesn't look like it's gonna come out. I mean, so far 20 years, we know that it's start arbitrage, but we don't know what else they are putting behind it. And there is an anecdote, really good. I want, if you read his book, it's really a good book. So he's the best. Like, we're talking about him. Everybody on Wall Street talks about him. People fought with him in court because he returned their money. Because before he went to private and made everybody partner, they returned the investors' money. And so people took him to court. You cannot return the money back. In any case, in the crisis, he was talking to other people, and he mentioned this in his book. He got doubts that, what's going to happen to his fund. Maybe he's going to lose. He was having, like, I don't know, 10% drawdown. And so that's why I always bring the psychology back, which I told you is focus on the drawdown, because it's very hard to have a 20% drawdown on $1 million. It's a lot easier to have it on a $10,000. And let's reiterate this, which is even the best of the best will have doubts in a drawdown. I found that very interesting. And of course, I've been through it. I can tell you it's extremely, extremely hard. And you will drop your systems in a big drawdown, which is the worst thing you can do to your portfolio.
So what Tim Master suggests is like putting the Monte Carlo on the data, like shifting. You find the differences between like, let's say, your ranges and the days and all that.
Yes, so that's what SPP is doing. So you're suggesting that you bring Monte Carlo, and instead of shuffling the trades, now you say, well, okay, look, if I am going long after 200-day moving average, do it after 200-day moving average. Correct? Is that?
Well, I don't think it's SPP, because SPP I thought it's more of sensitivity testing. That's how I looked at SPP. So the data is the same. The time series is not being changed in the SPP.
Yes, you can add noise to it in Monte Carlo. Correct.
Yeah. So with what Tim Master says is, he's saying the beginning and end of the time series is the same, but you're shifting what's happening in between, like the moves in between the two bounds, and then you run your system through that new time series, and the aim is to, I don't know, test the robustness. I was thinking, is it worthwhile to do such a thing?
The problem I have with Monte Carlo, so there are good Monte Carlo testing software, because what we have is the lower end of what Monte Carlo should do. What we have is shuffle the trades, add some noise, and that's it. But what you notice in financial markets, volatility lumped in sections. So let's take, let's say this is a time series. You will find that volatility, for example, high here, and then low here, and then again high here, and then low here. What Monte Carlo does when it shuffles, it doesn't take that into consideration. Not all of them. I'm saying the lower end. So there are good software Monte Carlo that take care of this. So what they do is they shuffle this. So they bring this whole circle here, and they bring this whole one here. So they shift the whole block. They don't shift one bar at a time. That's a good shuffling, because that keeps the data signature close. when you shuffle the bars or when you add noise, that doesn't add a lot. And I've proven this in one of the videos, because if you give Monte Carlo enough, when you give it enough average trade, if your average trade is $1,000, it's hard for Monte Carlo to fail that strategy, because all the noise in the world will not be enough to make $1,000 minus $1,000. I mean, it can, I'm not saying, but I'm saying most likely. So the software, unfortunately, then, look, at the end, you want something practical. Yes, you want to develop strategy, you want to trade the strategy. Like I mentioned in the beginning, you can make things complicated or you can make it simple. There are definitely 100% better solution than what we have. And you can go that route. I mean, I can show you the... So Monte Carlo, I remember one. Yeah. So this is one of the best solution using Monte Carlo. But of course it's complicated. It's not as easy. And you cannot make a workflow around this. I mean, again, not you cannot. You can. But you need to be, good with stitching software together, automation. The advantage we have in SQX is automation through custom projects, and anybody can do that. Of course, you will have to sacrifice something for this simplicity, and you sacrifice the robustness of Monte Carlo. So I don't use Monte Carlo as robustness in SQX. If you go to risk in Palisade, then yes, you can use Monte Carlo, but you have to go through this. It's really hard to do. So I have SPP, and bear in mind, SPP also, it's not perfect in SQX. I mean, it doesn't take the full spectrum if you have complicated strategies, and it doesn't add the shuffling, which is recommended by the inventor. So it's not also perfect, but it is good enough. Okay, it is good enough to produce strategies on it. So, but that doesn't mean there is not there are other. That doesn't mean there are no other solutions. Of course, there are other solutions, and probably better solutions. But you need, at the end, it's you. It's how comfortable you are with this. Can you automate it? Probably you don't want to automate it. Probably you just want to build 15 strategies and be done with it. So the whole automation thing is not even valuable to you. So this is, I would say, nothing wrong with that route, but I would say it's a personal route. But if I'm teaching someone, which what I'm doing here, then I teach you not to go that route. There is nothing wrong with it. I'm just saying it's adding more complication without any significant return to it. Again, this is me after going from nothing to extremely complicated and coming back to the middle. I've seen lots of money trading. I've seen 350 million hedge funds, what they do, and I've seen $2,000 account, what they do. And this is my conclusion. After all these years, after my experience, I came to this conclusion that complications needs a team. Alone, it's gonna be very hard to do. Or, which I've seen this, by the way, and I've been there also. When I went to extreme in programming, all was I doing was developing indicators. Like, it stopped being about trading anymore. It was me about developing this, making this perfect, and it totally went away from trading. And I've seen this happen with also many programmers, because programmers tends to have this thing. It's programming what they like. It's not trading. And so when you have a team, then you can do this, because then you could be a programmer and somebody could be a trader and somebody could be managing the whole fund, and then it could work. I didn't find it successful with one guy being the programmer, because he will always be seeking newer things to do better, or a newer language, or a newer platform, or a newer indicator. He will always be on the lookout for these things. This is my experience. I could be wrong, but that's what I've seen in myself and in others. And so, but if you want to trade, I can guarantee you can make money with simple strategy. Guarantee you.
Yeah, thanks. I think I agree with most of what you're saying anyway. I think especially on the team aspect as well. Because being in a team has allowed me to, not to a hedge fund or anything, but it has allowed me to focus less on other issues. And when you've got somebody reviewing what you're saying, they can tell you to F off. Focus on the important things.
Which is nothing wrong with that, because it's your goal. Yes, it's what makes you happy. So this makes me happy. Okay, I'll do it. So money now is not everything. I mean, I want to make money, but I also want to be happy. So if this makes me miserable, I will not do it, even if it's more money. So there is, again, this is just like the time zone. There is no right or wrong here. So both paths will need to profitability. Both paths will need to happiness. So I think it's a personal journey. But let's say if you are here, I'm teaching you from scratch. I will teach you to go simple. Do not complicate things. And yes, there will be strategies making more money than you or better, or they are developing it in different ways. But that's totally okay. You don't have to mimic them. You have your own path and you're making money. I told you I'm making an interview with Perry Kaufman. It didn't happen yet, so he had a busy schedule this week. But Perry is trading now for 40 years. He's been through 2 hedge funds, his own. He is consulting for many hedge funds. And he trades even simpler than my strategies. So that's what makes him happy. Yes, that's why he's still trading at his age. So even though he's been through even more than what I've been, but again, so there is nothing wrong with being more complicated. From my experience, you need definitely a team to success at complication, to have success. If you are not a team, I would focus on simple things. And remember, nowadays with this tool, let's say with the SQX, you're not depending on one strategy, you're building a portfolio. And even when a portfolio is trading, you can replace strategies. So that's the beauty. Your strategy does not have to perform for the next 20 years. Anytime your strategy degrades, you will be replacing it with a new strategy. And that's, I think, from this workflow, I don't need to have a strategy that will work for the next, 20, 30 years. Because that's what Perry come from. He wants a strategy that will work for the next 20 years. And so that's why he's only long term, and even his mirror version is long term.
Thank you very much. I think the point on the SQX is some of the things we can't do because architecturally we are hamstrung on that point. We had a chat with Mark, architect, and so some of the things that we were dreaming of we can't do in SQX because it's code, as you know, as a developer.
Yeah, no, I totally agree. He is that's what also CloneX told me regarding the SPP, because I want to implement the monitoring, and something is architectural but he said, I'm assuming the new version, because he kept telling me to wait because the new version he can do it. So that means something is changing. But also we have to keep in mind that it will never be perfect. Again, like if you can build strategies and make money, that should be okay. It will never be perfect. And I can tell you all hedge funds have their own software, all of them. Like they might have some tools to help, like commercial tools, but mostly they have their own platform, because inevitably that you will come at something that you want that's not available in a commercial platform and you want to customize. One of the only good platforms that I found is ADL, which is again, if you're a programmer, this you will love. So this is a commercial programmable platform. Okay, so if you are a programmer, you will find many tools available here with a easy programming language. And so if you plan to learn anything, then I would go this route, because this platform is let's put it's extremely good, and you can hook it up with any broker, and it has graphical interface also. This is one of the best platforms if you want to go a step further. Okay guys, so I think we will end it here. Thank you very much for attending, and I wish you a great weekend. We'll post this Tuesday, hopefully, and I will probably, I'm late on the comments in the Excel sheet, but it will always be updated. So as I mentioned, the Excel sheet is a work in progress, and if you have any comments there, please let me know. If you find any mistakes, also please let me know, as it will benefit everybody. And for the people who doesn't know about it here still, there is an Excel sheet that has the questions with the timestamp and the episode number, and so you can find answers quicker. Okay guys, take care.
Thanks, Ali. Have a nice weekend.